Okay, guys, again, thank you for coming for tonight's virtual meetup. We have a special guest, Adam Doran. My partner, Joe, will introduce who Adam is and what he does. Let's go.
What's up, everybody? Yeah, so we got Adam. He's a former police officer turned wealth advisor. Adam's been investing in real estate for 10 years. Started wholesaling, moved into single family homes using creative financing and BRRRR strategy. He's accumulated multiple single family rentals in Kansas City, lives in Kansas City. And then he's later sold the properties, and then more recently his transition to multifamily. Now he's owner of a 52 unit with some partners in the Kansas City area. Adam also works full-time in financial services now. And his specialty is helping real estate investors insulate themselves from taxes, market volatility, lawsuits, etc. And I will let Adam fill in any gaps that I left there and take it from there. So welcome, Adam.
Thank you, Joe. That was a great introduction, I feel like, and I feel like that did a good job summarizing. And Yosef, also thank you guys just for the opportunity to share. I see some familiar faces here on the group. So for those of you that I recognize, it's great to see you on here, Hendra and Mercy and Bob. And thank you everybody else that took some time out tonight. I'll be conscious of time tonight, okay? So we'll make the best use of the time. I'm going to be concise in what I share, but try to give you guys kind of the critical details. And then my hope is that tonight maybe just stimulate some new ideas in your mind, maybe generate some questions. Maybe this topic of life insurance as an asset class is something you've already been researching, but if not, tonight you'll walk away with more stuff to research and ask questions about. Or if this is something that is totally new to you, then just sit back and enjoy, because I'm going to share some really powerful stuff. Before I jump into my little presentation for you guys, I want you to know this is not only something that I specialize in doing as my business, where I'm sharing this with people every day. I'm a real estate investor myself. I use this strategy myself. Our family uses this as a financial cornerstone upon which we build all the other pieces. I don't think this is a silver bullet or an end all be all. It's just one part of a well-coordinated strategy. So you're on here tonight because you invest in real estate, or you will be investing in real estate. This strategy I'm going to share with you tonight only helps you do it better. That's all. So it's not an either or, it's an and. So with that, I will go over to share screen here. And you may need to pass the ball to me, Yosef or Joe.
I just did.
Okay. Try again here. Yep, looks like I got it now. And I'll go to slideshow mode and I'll check with you guys here in a second. Okay, does everybody see where it says capital strategy and it's got the blue and white?
Yes.
We good? Just some head nods is good? Okay, perfect. And then the other thing is, guys, if you have questions I'm going through, feel free to type them in the chat. Hopefully Yosef and Joe, you guys will monitor that. I'll probably roll straight through, but we'll be paying attention to the questions and we can get to them towards the end, guys. I expect to take 20, 25 minutes to share the content, and then the rest of the time devoted to questions and clarification. Okay, so really, I like to start with asking the question why. Before we get any type of strategy, any type of new thing that I might want to try or look at doing, always ask why. So why are we even in real estate investing in the first place? And I think everybody's answer starts with freedom, right? And we all want financial freedom. Everybody talks about passive income and having that ability to, do what I want when I want and be able to afford it. And I think ultimately it's not just the financial freedom, but the time freedom. So that's the lens that I'm looking at this strategy through, is how can this help me achieve these ends faster and or better? And so that's the lens that I'm looking at this through. And I always like to ask questions that reveal blind spots in my overall strategy or plan, because I don't think it's the things that you've already thought about that are going to get you, so to speak, but it's the things that we didn't plan for that catch us off guard that can really ruin a plan or create a problem for us. And so what I like to do when I'm in my meetings with the clients I work for is ask questions that reveal blind spots. And the questions that I want to ask you as real estate investors tonight is just 3 questions. The first one is, when you think about your capital strategy, so what you do with money as you're accumulating money to do more deals, as you're in between deals, and as you're in a deal and you're collecting income, is your capital protected against market risk? And are you insulated from rising tax rates? So that's the first question I want to ask you, just to kind of get the wheels turning in your mind. Second question I want to ask you is, every time you choose to use your capital and deploy money into a deal, is there an opportunity cost? And what is the opportunity cost every time you interrupt the compounding growth of that capital? So what's the cost there? And then the last question I want to ask you tonight is your personal wealth totally concentrated or mostly concentrated within your business? And the reason I ask that is because it doesn't matter if you're in real estate investing or any other business, because I work for several business owners, and they're in, various different businesses. What I find is a common thread through any business owner is almost all of their personal wealth is wrapped up within the business. And so tonight I'm going to focus on these 3 questions and providing answers or solutions to the blind spots. So we're going to show you tonight how you can insulate your capital from market risk and rising tax rates. I'm going to show you how you can actually enjoy uninterrupted growth of your capital, whether it's sitting in an account or whether you're deploying it into a deal. And I'm going to show you how you can accelerate the process of creating wealth by growing multiple assets simultaneously. In other words, we're going to show you how to make $1 do the work of $2. And so first, I think it's good to ask the question of, okay, well, when I think about where I put cash, where do I put it in the first place? And for most of America, if you're in America, there's 3 places you can put cash from a tax perspective. The first one is in a taxable account. These are things like your checking and savings accounts, a brokerage account like Robinhood, E-Trade, TD Ameritrade, where you're trading those dollars, trying to make a profit on them while they're sitting in cash. Bonds and CDs are also included. But when we think taxable accounts, generally we think liquidity. And so it makes sense to have money in taxable accounts because generally those are our most liquid accounts where we can move money in and out very easily. It's where we do our transactions. So there's a reason to have money in that bucket. The unfortunate thing about this bucket is, you get a 1099 every year for any earnings or capital gains you make in this bucket. And so, it's taxable. So it's possible to have too much money in this bucket. So then the next option from a tax perspective is we have the tax deferred bucket. So this is all your traditional retirement accounts, 401ks, IRAs, 403bs, all that letter and number soup. I call it alphabet soup accounts. And the nice thing about a tax deferred account in the short term is I can make 100 grand this year. And if I put 20,000 in this tax deferred bucket, I'm only going to get taxed this year on 80 grand. The flip side of that coin is at some point down the road in the future, I've deferred the taxes, hence the name tax deferred, and I'm going to have to pay them at some point. And I don't know what the tax rate's going to be whenever that point comes in the future. And so do I really have control, and how can I really plan effectively if I've deferred the taxes and I've deferred the tax calculation on that money? So this is where most people are accumulating the majority of their wealth, is in these first 2 accounts, because they're the ones that are talked about the most. And if you have a full-time job like a W-2, the default setting is to be saving and accumulating money in these 2 types of accounts. And so what I find for all the clients that I work for, and when somebody comes to my office or we meet over Zoom for the first time, 80% or more of all the wealth that they own is in these first 2 buckets. But what's interesting to me, it doesn't seem to get talked about very much, is there's a 3rd bucket. There's a tax-free option. And I always wonder why we don't pay more attention to the tax-free option, why that bucket seems to get ignored. Like if you read the Wall Street Journal or Forbes, you just don't hear much about building tax-free wealth. And so I'm really passionate about helping people get out of this situation where they're over-concentrated in accounts where they're either paying taxes now or going to have to pay taxes later, and trying to help get more allocation into a tax-free account so that no matter what happens with the tax rates, I don't have to worry about it. And so I would just ask you guys, and it's a rhetorical question because I think I know the answer. It's probably part of why you're in real estate, but do you think taxes will be higher or lower 10 years from now? Because I firmly believe they'll be higher. And if you believe that like I do, then you're probably very interested in, okay, how can I get more into this tax-free category? So we're going to spend the balance of our time talking about how we do that. And the first option for this tax-free account is Roth IRAs, which are a wonderful tool for getting money into them because you can take advantage of tax-free growth. You can take out income in retirement tax-free. And there's some built-in asset protections because retirement accounts are afforded some automatic asset protections. Unfortunately, Roth IRAs have some limitations. In order to make the money grow in a Roth IRA, you deposit that money in, you got to do something with it. You have to subject it to downside risk. So that's one of the limitations. Another limitation is you can actually earn too much money to contribute to these types of accounts. And a lot of the clients that I work for, they make too much money to be able to make regular contributions to a Roth. The other thing is you're going to be capped on your contributions to $6,000 a year, unless you're 50 or older, in which case you're capped at $7,000 a year. Well, if you're making $200,000, putting in $6,000 or $7,000 a year is nice, but it doesn't really move the needle. And then of course, when you put money into this account, you're not allowed to take it back out to your 59.5 without penalties. Now with Roth, you can take out up to your basis, meaning what you've put in. But if there's gains, you can't access those gains till you're 59.5, unless you want to pay taxes and you want a penalty. The other thing is the IRS knows about every dollar that goes into these accounts. And so if you're looking, to diversify and get into a situation where you can have some off the radar assets or off the balance sheet assets, you want to look at other options. So the next option, and where we'll spend our time getting into specifics tonight, is cash value life insurance, and specifically dividend paying, participating whole life insurance. And I'll get more into the details of that. But the reason it's an interesting asset class and it's something in the tax-free category we probably want to look at and research is it gives us all the same benefits that a Roth IRA would give us. We can put money into that account and not have to pay taxes on the growth. And if we do it right, we can actually take out tax-free income that is totally non-reportable and flies under the IRS radar. And in most states, and it does vary by state, so you want to get familiar with your state laws, but in most states, you've got some of the same asset protections built in that you do with retirement accounts. In my home state of Kansas, my cash values within my life insurance policies are totally protected from creditors. So there's some built-in asset protections similar to the Roth. But unlike the Roth, you don't have any of those limitations. As a matter of fact, when you make deposits into a life insurance policy, if it's built properly, you'll get guaranteed upside accumulation. The insurance company contractually guarantees you upside with no downside risk. There are no income limits, so it doesn't matter how much money you make. This is an option for everybody. There's no contribution limits. So if you want to put in $6,000 a year, if you want to put in $100,000 a year, there's no limit there. And there are no withdrawal restrictions. As long as you structure the policy properly and take it outright, which we'll talk a little bit more about, you can access your capital anytime. And again, flies under the IRS radar. And the bonus, which I'm going to share and get into a little more details with you guys tonight, is you can actually see uninterrupted compounding growth within your cash account, again, if you build the policy properly. So let's talk a little bit about that, because I mentioned structure several times, and it really is the key component of doing this strategy properly. This is a very interesting, something you can take away tonight, and you'll be smarter than a lot of life insurance agents, frankly, just to know this one fact. There's actually a minimum and a maximum amount you can pay for a given amount of life insurance coverage or a given death benefit. So I'll use it as an example, $1 million death benefit. There's actually a minimum amount you can pay to buy that $1 million death benefit from the insurance company. And the insurance company sets that rate in order to be, competitive in the marketplace. So the insurance companies will assess their risk, and when they think you're going to die, they look at your actuarial math and they decide, okay, if we're going to promise to pay this person's $1 million death benefit to their family, we can charge all the way down to, whatever the number is. And that's the minimum. The maximum amount that you can pay for that same $1 million death benefit is not set by the insurance company. It's set by the IRS. And that should cause you to be interested. Why does the IRS care how much money that I would pay for a given life insurance policy, for a given death benefit? Well, the reason they care is because when you structure a policy like this, it comes with some tremendous tax advantages, and they put a cap on it, basically. They're going to make you buy enough death benefit to justify this as a life insurance policy. And that threshold or that ratio that they set is called a MEC, or a modified endowment contract. And understanding that fact that I just shared with you, you now know more than, I would say, 80 to 85% of the life insurance professionals out there who simply sell life insurance as a commodity based on price. You're now going to learn tonight about building life insurance as an asset class, and a very unique asset class that can do some very unique things. So understanding that this MEC thing exists, I want to show you in a picture to help you understand how this works. This is really critical because you can't just walk into any old insurance shop or to any agent and say, hey, I want to do this cool strategy. This guy told me I can invest in real estate and I can use whole life insurance as a place to put cash. They'll sell you a policy. It might not be structured right. So we're going to talk about how to structure it right. And here it is in pictures. So a traditional whole life insurance policy, if you would go into, you name the insurance company, if you would go into their local office and say, I want a whole life insurance policy and I want to accumulate cash value, they're going to build you a policy that looks like this picture on the left. And it's going to be optimized to your death benefit. In other words, they're going to say, well, let's talk about what you need for a death benefit. And they're going to help you find that magic number through whatever formulas and equations they use. And let's just say they come up with $1 million. They're going to sell you a whole life insurance policy with $1 million death benefit for, the lowest, most competitive premium they can offer. And what you're going to end up with is a lot of death benefit and very, very little cash. As a matter of fact, in the first few years of the policy's life, you'll probably have zero cash value. And that's what it looks like under the traditional model. That cash value never comes anywhere close to approaching the MEC line. Well, we're going to turn that model on its head and say, I'm not so concerned about buying death benefit. I want to get as much cash as I can into this and as little death benefit, because I really want to get as much cash accumulation going as I can. And that looks totally different. It looks more like this. So we're going to find out what is the least amount of death benefit the IRS will let us purchase for, let's just say, Yosef, you come to me and you say, Adam, I want to put $1,000 a month into a strategy like this. We're going to reverse engineer that asset and say, what is the least amount of death benefit I can get away buying if I'm putting $1,000 a month into this? And therefore, that's going to allow me to build as much cash as possible as quickly as I can. The other thing is, this can't be done with just any life insurance company, because many of them do not offer the right kind of policy structure. So without going on to a deep dive on that, and I want to keep the presentation moving, I'll just share with you guys, we're looking for financially sound, stable, mutual life insurance companies that pay a participating dividend to policy owners. And there's only a handful in the country that offer the right kind of policy structure. So before I jump more into how does this look when I apply it to real estate, I want to take the conversation outside of just me and my credentials and give you guys some examples of some people you may recognize that use this asset class in their lives, and maybe encourage you why it's worth researching for yourself. So let's look at, this strategy in action with a couple different case studies real quick. Walt Disney in 1955 used a policy loan from a whole life insurance policy he owned to fund the startup of Disneyland, because of course a bank wasn't going to finance a crazy idea like that. So he got together some friends and private investors and also kicked in some money of his own from his whole life insurance policy. So we have Disneyland and Disney World today because Walt Disney, in part, took money from a life insurance policy he was building as an asset. You may not recognize this lady. This is Doris Christopher in 1980 in her kitchen in Chicago. She and her husband took a loan from a whole life insurance policy to start this little company in their kitchen. So they only took like a $3,000 loan, so it can be something big like Disneyland, or it can be something small like a home-based business. And she eventually sold what became a multi-billion-dollar kitchen tools and kitchen accessories business. She sold that to Berkshire Hathaway. The name of the business you'll recognize is Pampered Chef. Joe Biden, I think it's kind of a timely example, new president-elect coming in. He owns 6 whole life insurance policies that I highlighted there. This is his personal financial disclosure document from 2011. And you'll notice the column there at the top, see it says assets and income. So it's kind of interesting to me that Joe Biden includes this on his balance sheet as assets and income, not as expenses, assets and income. So kind of a hint as to where, we're going as far as what we're going to look at tonight. How can this be an asset and provide income? Jim Harbaugh, a big portion of his compensation with the University of Michigan is a permanent life insurance contract. and he leverages life insurance loans for tax-free income. Won't get into the details, but I'm just giving you guys some case studies so you can check this out for yourself. So you know it's not just me this is coming from. And then finally, the biggest buyers of whole life insurance in America are banks. It forms their tier 1 capital is what they call it, their safe capital. It's also what they use extensively to give discretionary executive benefits. So whereas if you are a business owner and you have employees and you do a 401k program, if you give it to one person, you got to give it to everybody. With whole life insurance as a tax-free retirement plan, you can selectively give it to who you want to. So banks will use it as a discretionary executive benefit. So all of these examples in mind, and in light of this, I felt that's a good way to kind of frame up and say, hey, if this is a new concept to you, don't take my word for it. Go research the information that's out there, because there's a reason these wealthy and affluent people and the banks are very interested in this strategy. And a lot of it relates to tax benefits. So let's go ahead and just bring it down to okay, how's this impact you and me, and how could this be useful in our world of real estate investing? This is a case study of an actual client of mine, 40-year-old female real estate investor. At the time we built her plan, this was a couple years ago now, and she had $2,000 a month that she was from various places in her budget was allocating towards future savings, future growth, was going to be a part of her real estate capital funds. And so part of it was she was over contributing to a retirement plan that was tax deferred. Part of it was that she had money sitting in a savings account. And part of it was that she was peeling money off of every paycheck and everything she was earning and putting it away. And so we basically kind of took a holistic view, top-down view, and said, okay, here's $2,000 a month that if we reallocate it, it's not going to make a difference to you. You're already putting it in different places. What if we allocate it here and create a cash account that can support you acquiring additional real estate as time goes on? And so that's how we built it. And in her case, she's going to fund this from age 40 to 65, doing $2,000 a month into it. Now, you don't have to make that kind of commitment. You can fund it for 10 years, 15 years, 20 years till age 65, or for the rest of your life. It really comes down to having a conversation with the expert you're working with and deciding what structure makes the most sense for your situation. But for her, this is what she wanted to do. And so just to give you an idea of what that cash account looks like as the years go by, there at age 45, she's at 83,000. All the way up to age 65, she has just shy of $1 million of tax-free bucket of money. And at any point along the road, she can use this cash value to help her go purchase real estate. So let's just look at 3 quick examples of purchasing some real estate assets. Example 1, at age 45, she's got, hey guys, real quick, before I go any further, on my screen, it shows people's faces in the way of the slide. Are you guys able to see my slide okay?
Yes.
Okay.
I see your slide as a full screen.
Okay, perfect. Thank you. So let's say we're going to build a real estate portfolio. Let's do example 1 will be at age 45. She'll deploy a $50,000 policy loan. And you'll notice at age 45, she's got about $83,000 to work with. So she's going to deploy $50,000. And let's say she uses that as maybe a down payment on a single family home, or in some parts of the country, that could be the entire purchase price of the home. Just depends on where you are. I know in the coastal markets, $50,000 is not enough to buy property, but regardless, she's going to deploy that into this deal. So down payment or otherwise, she acquires a single family home. It could be a flip, right, where she exits in a few months. It could be a buy and hold, and maybe her exit plan is a refinance. Regardless of the exit, let's just say in either the next 12 months, if it's a flip, or maybe in the next 3 years, if it's a refi, she gets her 50 grand back out of the property, whether that's selling it or refi. She puts the money back into her capital account at that point. And then let's say at age 50, she decides to do another deal. This time we're going to step up a little bit. She's got $217,000 available. She's going to deploy $100,000 through a policy loan, and maybe that's a down payment now on a fourplex. And so she gets into the fourplex deal, makes improvements, raises rents, forces some appreciation, adds value, does a refi in a couple years, gets her 100 grand back out of the property, plunks it back into the cash account here, into the policy. And then let's do one more deal. At age 55, she's got just shy of 400,000 to use. Let's say she deploys 250,000 and does what I did last year and gets into an apartment syndication and gets into that deal. And then maybe, takes a little bit longer time to return that money back to the account. But But anyhow, she returns the 250 grand, and it doesn't have to all be at one time. She could be making monthly payments back to her policy if she wants. She could leave the money outstanding for a while, and 5 years later, she gets it back in a lump sum and puts it back. Doesn't matter, totally unstructured. So she can decide. Well, let's just say she puts it back eventually. And at age 65, she now is not only sitting on the assets that she's accumulated here, but don't forget the fact that this cash value is there. So now we have this policy, which is a whole separate asset that's just shy of $1 million tax-free. And remember, this is a contractually guaranteed upside account. So whether, this is what I want to point out to you that's so powerful, whether she puts the money in each month and lets the account just sit there and does nothing with it, or if she takes and leverages the cash out and uses it to buy her real estate portfolio, either way, she has the 933,000 there at age 65. Either way. So I want you to think about that. She deployed 250, 350, she deployed $400,000 to acquire assets from age 45 to 55. And even though she deployed that $400,000, she never stopped earning compounding interest within the policy. And that's because of a unique feature with the companies that I work with and the policies we design, where even when you leverage out your money, you take a policy loan and you go buy a property, you're never slowing down the growth of the cash account. So I'm able to earn a return on the dollar within the cash account, within the policy, and I'm able to earn a return on the dollars as I put them into my real estate deals. I'm making $1 do the work of two, both in the policy and outside the policy with the investments. So the idea that I can have a cash account that even when I use my money, there's no opportunity cost. When I learned that about this strategy, this is what made me decide, okay, this is something I need to do for myself. This can supplement my real estate investing. So I'm not saying this is a strategy we do instead of our real estate. It's not an either or, this is an and. I'm going to do the real estate investing anyway. I'm going to buy the properties anyway. Where's a smart place for me to build cash and never have an opportunity cost to use that cash? And guys, I can't think of any other kind of account where you can do that, where you can have that kind of leverage on your dollars. And so that's why we're talking about it tonight. Now, real quick, before I summarize and wrap up here for us, I want to point one other thing out, because I end this scenario at age 65. Well, okay, I've got, passive income presumably from my real estate portfolio, and I've got this $932,000 in cash sitting there in a tax-free account. So what could that look like as far as a retirement income stream? Here's what it could look like. We put in $600,000 in policy premiums from age 40 to 65. That's what $2,000 a month turns into as we fund this asset over a 25-year period. In retirement, if we wanted to, this client could turn on an income stream of $85,783 a year from age 71 to 90. And remember, it's tax-free and it's off the IRS radar screen. If I was doing this through a tax-deferred account where I had to pay taxes on the money when it comes out, if I'm in the 24% tax bracket, I'd have to take out roughly $112,000 a year to realize the same $85,783 in income each year. But she's going to get $1.6 million in tax-free income out of this if she would choose to use this option of taking policy loans and basically never paying them back, taking them out as income. And then if she dies at age 90, there's still a remaining death benefit of $915,000 tax-free that will go to her family. So money in, $600,000, money out, a little over $2.5 million, all tax-free and all off the IRS radar. So not only was this my cash account to help support my real estate investing and accumulate in a portfolio while I was in my working years, when I get to my retirement years, if I want to turn it into a tax-free income stream, I can. So that's kind of the other, the long-term benefit of it. So I thought one more thing I would do is kind of compare this as far as when we think about other places we could keep cash and have liquidity and be able to do real estate deals. I was like, well, what if I compare this to a high interest savings account? And the highest interest savings account I could find earlier this year when I ran this scenario was 1.6%. Maybe somebody can find 2%, but that was the highest I was able to find back in March. So I just said, okay, let's take the same dollars and do the same thing with a savings account. and let's deploy the same 400,000 doing the same 3 real estate deals the same way along the line. And I spreadsheeted this out with Microsoft Excel. And what was interesting is with a savings account, you would have at age 65, 782,000 instead of the 900 and some. And you would actually get less retirement income simply because of the fact that when you start drawing money out of this account, you're also taking from a 401k presumably, or a pre-tax account. So you're going to have to buffer and pay some taxes as well. So you actually get less income out of the account than what you started with, and you run out of money at age 79. Versus here's the scenario I just painted for you with the policy. That difference in dollars, guys, has everything to do with 2 things. And I'm going to show you. One, remember I asked that question at the beginning, what's the opportunity cost every time I deploy capital? If you deploy capital through the business savings account where you're making 1.6%, every time you reset the compounding process by drawing money out of the account to do a real estate deal, you lose compound interest in the future. You never recover it because the money's out of the account. And then you also have to pay taxes all those years as you're earning the compounding interest, because each year you get a 1099. So there's your opportunity cost. And then when we look at the difference in income, it's astounding. So if you add all the numbers up, it's a little bit over a $1.1 million difference, putting the same $600,000 into just 2 different accounts. And so when I did this side by side, to me, it was kind of the nail in the coffin as far as using a traditional cash savings method. Like, why would I even mess with that kind of opportunity cost? So that's the math on it. But I understand, like, if this is something that's new to you tonight and you're looking at, you're like, well, I'm definitely going to have to research this. I would encourage you to do that. Because any type of financial strategy, when we're talking about, planning for the future and it playing into our overall financial picture, I think it's an important decision. I think it's important to research. But I just wanted to kind of paint that picture for you guys so you can just see in a very visual way that, the decisions we make as far as financial strategy, they have significant long-term effects and impact. So lastly, I would just ask, what could you be building based off what I shared tonight? And as a recap, we learned how we could insulate our capital from market risk and rising taxes with guaranteed upside, right? And a totally tax-free account. I showed you how you can earn uninterrupting growth, compounding growth on your capital. And I showed you how we can make $1 do the work of 2. I'm gonna put my contact information up for you guys. Would love to connect with you. So I've got my email up here, adoran@prevailiws. Got my phone number up there if you'd like to connect by phone. But I will tell you, my favorite way to connect is on LinkedIn, because then we can send voice messages back and forth, and it's a very handy way to like set calendar appointments and whatnot. Would love to meet and chat with you and definitely answer questions, because I'm sure everything I just shared, I dumped a lot on you quickly, and I want you to have your questions answered. And as you research this for yourself, I'm glad to be a resource for you.
Right. Thank you very much, Adam. If you could stop sharing your screen so that
Yep.
you can see everyone. I know, just like myself, some people will have like some puzzled face, right? But I'm sure this is something that I'm gonna look into further, and I think this is a great tool. So we're gonna open up for questions and answer section. I know David had some questions during the presentations. I think, why don't you speak up, David, and ask the questions to Adam?
Yeah, thanks, Adam, for the presentation. I was sort of just wondering the uninterrupted compounding or the uninterrupted growth. What rate is that generally? I mean, is that comparable to a savings rate itself, or is that higher, or what does that look like over time?
Really good question, David. And I want to make sure I'm clear on what you're asking before I try to answer it. Are you saying if I would look at the internal rate of return on the policy, what is my internal rate of return on my cash over the life of that account? Is that what you're asking?
Essentially, yeah.
Yep. So you're going to have a guaranteed rate from the insurance company of 4% over the life of the policy. So the tax equivalent of that's probably going to be more like 5 or 6, but 4% guaranteed by the insurance company. That's before they pay their dividend to you. So a dividend on top of that is usually going to add another 1 to 2%. So over the life of the policy, you're going to be in the neighborhood of 4 to 6% tax-free interest. So it's like a high interest savings account, but obviously, as you guys know, prevailing interest rates, that's higher than any high interest savings account I'm aware of that's out there right now.
Right. Okay. Yeah, that's substantial.
There's one other thing I would say to that, and that's a really good question, David. But one other thing I would say to that, now that I've given you a straight answer, is I'm going to give you the smart aleck answer. It doesn't matter. And the reason I say it doesn't matter is because you're not doing this for a return. You're doing this as a place to put cash safely, to know that it'll be there when you're ready to put into the deals where you're really going to earn your return, which is going to be your real estate. Or, if you're building some other type of business, that's where you get your returns, your real estate, your business, whatever it is you're investing in. So it doesn't matter. I would say, what are you going to do with the cash once it's in there? Because that makes all the difference. If you're not going to use the cash, then this is probably not the best vehicle, right? A standard 401k program at work might be a better fit if you don't plan to touch the cash and you plan to be hands off.
So that was kind of the second piece to my question. Is just, it seems like it's just a better option than, if most of the folks on here have, their savings and checking account that, they let it build up, to 50, 60, $100,000, and then they invest in a deal. It's just a better way of doing that rather than a kind of entire investment strategy.
That's my belief. And I look at this, again, not as an investment. I look at it as a capital platform. And it's my belief, as far as what's the best place I can put cash, this is probably the best place I can put cash. Now, that being said, my family and I keep an emergency reserve fund in our savings account at the bank, because why wouldn't you? If the car breaks down tomorrow, I can go to the bank, I can plug my card in the machine, and I can get money to fix the car. With a policy, I want to use that money to acquire other assets. And, frankly, I can't use an ATM machine. I've got to call the company and say, hey, I want a policy loan. And it takes me 5 to 7 days to get my money. So there's a reason to still have cash savings, obviously.
What does it cost? I mean, there must be some cost, right?
Yep. So again, going to try to give you a really abbreviated answer, and then, we can always have longer conversations offline, but the abbreviated answer is it's going to be similar to any other financial product out there. As an overall expense, you're looking about a 1% expense built into the policy over the life of the policy. You're going to realize all of that expense in the first 10 years of the policy's life. So it's not going to look like 1%. It's going to look higher in the first few years. But then there comes a time in the policy's life where you're putting in $1 and you're able to get out 5. So when you even it all out and spread it over the life of the policy, you're looking at about a 1% fee. Mm-hmm. And when an advisor illustrates that for you and builds it out for you, you're going to be able to see numbers net of fees. So you know exactly what you're able to put in and exactly what you're able to get out.
Did that answer, David?
Yeah, no, that's great. I appreciate it.
Thank you. I have good questions coming up, and I want to see some engagement. So, Travis, can you ask this question yourself? I think this is a great question.
Sure. My question is what portion of the premium that is paid in is actual premium to the insurance company versus cash that goes to your cash value?
Yep. Really good, Travis. I'm going to try to answer that really super simple. And then if you need more discussion on it, it's an in the weeds discussion, but the super simple answer is you kind of get to decide that from the outset. In other words, part of the process, if somebody's going to set one of these plans up for themselves, and this is what I went through when I did, my own that our family uses, you're going to go through underwriting or pricing from the insurance company, and you're going to find out, let's just say you're a 40-year-old male in reasonably good health. They're going to price you based on your age and your health. And then based on that, you'll know that for every $1,000 I put in, this is what it looks like in cash value in year 1. This is what it looks like in year 2 and in year 3. Those numbers are unique to everybody. So as an example, to kind of summarize, if you're 12 years old your cost of insurance built in that policy is going to be a lot less than if you're 60, right? And if you have sleep apnea and diabetes, it's not going to be near as favorable as if you run regularly and you eat vegan, so that kind of helps you understand at a high level. But the answer is you kind of get to decide in how you build the policy. And there's a little bit longer explanation to that, but there's basically some ratios that we use when we're in our design meetings with clients as far as, okay, how much of this needs to be available right now so you can use it on the next deal? And how much do you want to gear towards maximizing retirement income long-term? And there's kind of a sliding scale there. The other thing, just real quick to give you hopefully a straight, helpful answer as well, Travis, if you would build a policy that's totally optimized for retirement income and you don't necessarily need to use capital right now, your cash value in year one could be all the way down to 0% of what you put in year one. On the other hand, if you're not real concerned about back-end retirement income and you want to juice this thing up in the front years so that you can start using cash right away, you can build up to 70% liquidity of what you put in year one. And by the time you reach year 6 or 7 in the policy's life, there's more in there than what you've put in. So it really just comes down to how you want to build it.
Okay, thanks.
Thank you. James, you're next.
Yes, thanks, Yosef, and thank you, Adam, for your presentation. My question, can I convert my company 401k into a cash value life insurance policy? I have a policy now that, is doing little to nothing. And I recently started a self-directed brokerage account. But some of the flexibility I had with that away when we moved from Wells Fargo to net Fidelity net benefits. So I'm kind of back to square one where I'm very limited as to what I can do. So I was wondering if I can convert a company 401k into
Sure.
a policy like this.
Also a really good question and one that comes up a lot in client meetings. The answer is no, you can't just straight convert or do a rollover. And the reason is a 401k is going to be a pre-tax account and it is a qualified retirement account. A life insurance policy is not. It's considered by the IRS to be a life insurance policy. So it's a different type of asset. It gets a different tax treatment. You could, and this is not a recommendation, so please don't take it that way. You could withdraw money from your 401k, pay taxes and penalties, and shift it over to a policy. We've done that with some clients in very, very select cases where it made sense based on what they wanted. It is not generally a good idea. One other thing I'll let you know, James, and I don't know your situation, so again, please don't take it as a suggestion, but I want you to be able to know what's out there and available to you. If you've been looking at your 401k wishing that you could put that money into real estate or somewhere else, up until 2 days from today, the IRS does allow under the CARES Act for you to withdraw up to $100,000 out of a 401k right now without penalties. You'll have to pay taxes. You can spread the tax burden over 3 years, over the next 3 years, but you don't have to pay the penalty. And that goes away December 30th. I've had a lot of clients do that this year because they want to, instead of have that money be locked up in a mutual fund, they want to put it into real estate. Not in a position, because I don't know your situation, to give you advice on it, but I want you to know that that's out there and that's worth researching if you didn't already know about it.
Yes, I heard that. Thank you.
Mm-hmm.
Joe Sullivan.
Yeah, I think Adam already answered my question. It was about how quickly you can access the capital once you get it in. He said 5 to 7 days.
But that's if you strategically structure that way, right?
Yeah, well, two answers to that, Joe. Generally, let's say you started a policy today, you'll have cash value in your very first month, generally speaking. And depending on how much you put in, I guess, determines how much cash you have access to, right? So, but as far as like, once there's enough in there that you're like, okay, I want to start deploying capital through policy loans. Yeah, it's simply either a phone call or a one-page document to the insurance company, which you can do by email or fax. And, from my experience, it's 5 to 7 days and I have my money. It's a check in the mail is what they send you. And they send it out the day you request it.
I'm gonna do a follow-up. Can you invest a lump sum, a significant lump sum?
Also a great question. Short answer is yes. The second answer is that can impact what we need to do on design for you. And what I mean by that, just to give you guys a real simple example, let's say you're going to do like my client in the case study, and she funded this at $2,000 a month, which comes out to $24,000 a year. You could probably dump in 40, 50, maybe even 60,000 in year one, and we can get away with still doing 24,000 a year after that. But let's just say she wanted to dump in like $500,000, right? That she had accumulated in some other account. Well, she's not going to be able to do, $500,000 in year one and then drop it down to 24,000 the following year. And the reason being is because we would mech that policy every time, because the minimum death benefit that we buy with a $500,000 dump in versus the minimum death benefit we buy at 24,000 a year, there's quite a spread there. And we would not be able to preserve the IRS threshold between cash value and death benefit. It just wouldn't work. So we'd have to be thoughtful and strategic about how, let's just use my example, $500,000, how we move that money in. And what it would probably look like would be a year one dump in of as much as we can. And then we'd spread the rest in over the next 5 to 10 years is probably how we would do that. And just get it in as quickly as we could, because not the same, but similar to a Roth. Again, they do put a little bit of a cap on the benefit. So, if you start at 500,000 and then you drop it back the next year to 24,000, they're going to flag it every time and go, this isn't a life insurance policy. This is a tax-free savings account. So we have to be strategic.
Thank you. We had Chad. You want to go next?
Yeah, on the example that you gave, with the $2,000 a month premium, what's the death benefit on something like that structure that you gave an example of?
Yeah, totally varies by age and health. So if you're 20 years old, it's going to be a lot of death benefit because you're putting in a lot of cash. If you're 50 or 60 years old, it's not going to be much. Man, to even try to ballpark those numbers for you, I know I'm going to be wrong, but I want to at least kind of give you a picture. So 24,000 a year as a 20-year-old, that could be a $3, $4, $5, $6 million policy. 24,000 a year as a 50-year-old, that may just be $300,000.
So basically the play is it's a tax-free savings account, cash value that has some life insurance, but that's just a benefit of the whole thing.
Yeah, and that's speaking to designing it the way we're talking about, where we are intentionally buying as little death benefit as we can get away with. Okay, if you wanted to just straight up buy death benefit, then of course, as a 50-year-old, you can get a lot of death benefit for 24,000 a year if that's what you're after. That's not what we're after with this, as we talked about.
Okay, thank you. We have Travis, another question that was, I could just read it for you, Travis, for this one. What are the fees related to getting a policy loan and what interest rate is paid?
Yep, that's a really good question. I'll give you a straight answer and then I'll probably confuse you. The policy loan rates that I'm seeing in the companies we work with now, the lowest is 4.4% and the highest is 5%. So not a lot of spread there. While those interest rates may seem to not be competitive because banks will loan you at maybe even 2% right now on mortgages. What you have to keep in mind is you're still earning guaranteed 4% upside on that dollar, and you're probably getting a non-guaranteed dividend that's adding to that. So, and the other thing is when you use your policy loans, you don't slow down the compounding growth. So you're actually still earning money on dollars that you're borrowing at, let's say 4.4%. You have an arbitrage there. So your dollar is still earning compounding growth even when you use it. So again, I'm going to kind of go back to the question earlier about what's the internal rate of return or the interest on this thing. It doesn't matter. And the loan rate, I don't want to say it doesn't matter, but it doesn't matter, because how are you going to use the dollars? Because if I can get money through a bank at, let's say 3%, but the bank gets to dictate the terms, versus I can use money at 4.4% and I can have it in 5 to 7 days and there are no terms, I get to decide, I'm going to take the option that gives me more control, because it's what I'm going to do with that money. It's not just, the rates that being charged. I hope that's a somewhat clear answer. Hopefully that kept it simple enough.
Was that helpful, Travis? Any follow-up questions on that? All right, we'll pass on to the next one. John Weber, you could unmute yourself and ask a question.
Yeah, thanks, Adam. I just was curious, when it gets to structuring the policy, I didn't know if trust or some sort of entity could hold the policy. And just second question is just like the limits of what sources of income could fund that ULI.
Yep. John, any source of income that is your own can fund a policy. And not to get off track, they'll also allow you to fund policies with borrowed money. I highly, highly discourage that. And I won't write a policy for somebody who tells me they're borrowing cash to fund it. There is another part of the question that I didn't want to miss. John, remind me what the other part of your question was.
Oh, just like what entities, like if
Entities, trust. Yes.
Yeah, trust. Yeah.
Yep. Good question. Trusts can own a policy. They can also be a beneficiary of a policy. That's a way deep in the weeds conversation, and I'm happy to have it with you. But to avoid confusing everyone on the call and to make sure nobody misconstrues what I was going to say, I would just tell you that that's something you want to probably have every member of your personal financial board a part of that conversation if you're thinking about involving a trust, because it can be beneficial. It can also make your life really unnecessarily complicated. So you just want to fully understand your situation and what's most advantageous to you, because 90% of the time when a client asks that question in our meetings, what we end up deciding is they still want to own the policy personally. It's not really beneficial to have the trust be an owner. But oftentimes we will see a trust be a beneficiary because it fits the family legacy plan.
Okay, thank you. I think that was the last question we had. I just have one question and then we could probably wrap it up. So you use $2,000 per month as an example. What would be the, let's say, call it minimum amount that you recommend to have to start this? Because not many people can dump in $2,000 each month, right? So what would be your recommendation for that?
I appreciate that you asked that, Yosef. I'm glad you asked that. And it's always hard when you show an example, because I never know, depending on the group I'm talking to, what, does that even look like their world? And I will tell you guys this first off is, I see what Pat just said about IRS radar. I'll get to that in a second. What I started was my first policy, I paid off a car. I finished paying off a car. And so I had an extra $500 a month. And so since that was already built into my budget, that's how I got started. But to truly answer what's the minimum, I have clients where their child is the insured on the policy, all the way down to $200 a month that they're funding these. And then I have clients on the other end of the spectrum where they're super high income earners and they need a place to put cash and have it be tax-free, doing $100,000 a year in premiums. And so anywhere in that range, you can build something to fit your purposes. I would say, though, that probably as a minimum starting point, you need to have free cash flow of at least a couple $100s a month, because otherwise it's hard to build anything of impact. We can build a policy with a child at $70 a month, but it's not going to be impactful. And frankly, if that's a big number in your budget, then there's other things you probably need to be getting in line first before trying to implement a complex strategy like this. So, time to do more real wholesale deals or something before getting into that. Real quick, I did want to respond to what Pat said. You keep saying not on the IRS radar. What if one is audited and it is on their radar? That's a really good question, Pat. And frankly, I have not had a client come to me with a problem with an IRS audit. But here's the thing. The reason that it's off the IRS radar is they have that MEC limit in there. And if you violate the MEC limit, which, by the way, the insurance company tracks, by law, they're required to track that. If you cross the MEC threshold and your policy is a MEC, it's going to be reported to the IRS at that point, and it's going to become taxable. So to avoid reporting it to the IRS and to keep it tax-free, we structure it properly under the MEC limit. And so when you say, well, what if somebody's audited? It doesn't matter. doesn't matter if you're audited, it doesn't come into play on your taxes. You're not doing anything unethical. You're not cheating the system. Life insurance is treated differently by the IRS than taxable accounts. It just is, or tax deferred accounts. So it's not a concern for an audit. It's just not.
Thank you. We have one more question from Ian. Can someone from another country, Ian, I know he's from New Zealand, take advantage of this?
Short answer is yes, Ian. I'm not sure what the rules are or what products are available in New Zealand for you. So unfortunately, I can't answer you tonight if it's something that you can do. I know there are people in Canada using this strategy. Also, Ian, I'm not licensed in any other country besides the US, but I would say maybe a Google search of life insurance practitioners and maybe interviewing a couple folks, a couple professionals, and seeing what you can find out.
All right. So thank you very much for your great questions and answers. I didn't expect this much questions. Adam and Joe, when we discussed in the beginning, we were just thinking about maybe me and Joe having like a bunch of questions, but I think this was a great session. And again, thank you very much for your time, everyone. This was
Thank you, everyone.
Multifamily and More virtual meetup, and we're looking forward to see you for the next month. We're gonna announce one soon. Okay. And thank you, Adam.
Joseph,
Yes.
we got to get Adam's contact information. How to get a hold of Adam?
Oh yeah, we're gonna send that out to everyone because the
Okay.
recording is gonna be sent to everyone who registered for this virtual meetup, who also didn't make it tonight. Okay.
Great. Thanks, Adam.
All right.
Thanks,
Thank you
guys.
very much.
Really enjoyed
everyone.
it.
Guys,
Thank you guys.
Happy holidays.
Thanks,
okay?
Adam.
Yeah. Happy New
Thanks,
Year,
everybody.
everyone.
Bye.
Bye-bye.
Bye.
Bye, guys.
Happy New Year.
Happy New Year. All right.
That was great.
That was good. That was good.
Yeah.
Hold on. Let me turn off.
Thank you, guys.